So we look at global debt because that's how money is created in this system. And this is fiat money versus sound money. They're both money. They're just the flip side of the coin. So with debt, which is how money's created currently, it's an unlimited amount, right? That's why every time there's a problem, central bankers go to their printing presses because they can. There are no limitations on that. Now, every time they do that, the purchasing power of the value of the currency goes down, but what do they care? They get to use it first when it has its most value. It's us, the public, that has to deal with everything else. But the global gold supply is finite. I don't care if they find a new discovery. Anytime anything is physical, there's going to be a limited amount of it anytime. So the fundamental value that I'm about to show you represents the true value of gold, the fundamental value of gold on a 1-to-1 cover ratio, which means that this is how much it's really worth. When they do that overnight reset, I can't tell you what the cover ratio is going to be at that time, and nor can I tell you what the fundamental value of the gold is going to be at that time, because it depends on the level of debt that they've grown. But let's just stay with current, so we're dealing with facts. And the global debt at 313 trillion, not counting all the derivatives or all the other wonky products and complex products that Wall Street creates from it. So that's 313 trillion. And the global gold supply is almost hundreds, thousands, millions, 7.498 billion ounces. That's it. And that means that the current fundamental value, which you've heard me say, and I know it sounds crazy, is over almost $42,000 an ounce. And the fundamental value of silver is 2,000. This is how you know that it's so severely undervalued, because they're going to hide it until they can't. And we've seen this happen over and over, even currently, in a whole bunch of currencies that are dealing with hyperinflation. So all you need to do to determine the true value of an ounce of gold for its most important function, which is to hold your purchasing power intact, is divide the debt by the gold. And that's how you get that 42 grand. And silver, remember, is historically, when they did this is a 20th of an ounce, this is a full ounce of silver. So at a 21-to-1 ratio, that's how you get over $2,000 right now for the true value of silver. So can you see how severely undervalued it is? It will go to its fundamental value. I can't tell you exactly when, but I can tell you that it's happened over 4,800 times, 100% of the time. It's the way they attempt to get your confidence back. But this data then helps determine how much silver and how much gold do I really need to accomplish my goals. So the first goal is to sustain your current standard of living, and that requires your barterability. And so what we do is we take into account how much it costs to live, what your property taxes are, all of your fixed rate debt, your insurances, your medical, and hopefully this is not you, but if you have any chronic medical condition, you have to deal with that as well. So we have to know, how much are we needing to cover?
The thing is, our current financial system is built entirely on fiat currency. That means central banks can create money out of thin air. Every time they press that button, more dollars flood the economy. And with that, your purchasing power quietly evaporates. They don't feel it first. You do. So here's the big question. How do you protect yourself? How do you make sure that the wealth you've worked hard to build isn't washed away by inflation, debt crises, or financial manipulation? The answer has been the same for over 5,000 years: gold and silver. We touched on this earlier, but let's break it down further. Based on today's global debt levels, a staggering $313 trillion, the fundamental value of gold is currently sitting at over $42,000 per ounce. Silver? It's around $2,000 per ounce, not the measly $30 per ounce it's trading at today. You might be thinking, Lynette, those numbers sound insane. How could gold and silver be that valuable? Let's take a historical perspective. Governments have a long history of resetting their financial systems through gold. This has happened 4,800 times in recorded history. That's not a theory, it's a fact. Every time paper money collapses, They go back to gold and silver because, unlike fiat, they are tangible assets that can't be printed into oblivion. In 1933, FDR confiscated gold and revalued it from $20 to $35 per ounce. In 1971, Nixon severed the gold standard entirely, allowing unlimited money printing, and we've seen exponential inflation ever since. Now, with global debt at catastrophic levels, we are staring down the barrel of another monetary reset. The question isn't if it will happen, but when. And when it does, guess what? Gold and silver will be revalued to reflect their true worth. Let's play this out. Imagine a full-blown financial crisis, one that's worse than 2008. Banks are collapsing, stock markets are in free fall, and the central banks are scrambling to fix the situation by printing even more money. What happens next? Your dollar savings lose purchasing power at an accelerated rate. Hyperinflation kicks in, making basic goods unaffordable. Confidence in paper assets like stocks and bonds erodes. Gold and silver skyrocket as the last safe haven for wealth. Sound crazy? It's already happening. Argentina, Turkey, Lebanon, Venezuela. Countries that ignored the signs saw their currencies implode. But those who held gold and silver retained their wealth and survived the economic storm. Now let's talk about silver. If gold is the king of monetary metals, silver is the secret weapon. Historically, the gold to silver ratio has hovered around 16 to 1. That means for every ounce of gold, silver should be worth 1/16 of its value. But today, that ratio is a staggering 80 to 1. That tells us one thing: silver is massively undervalued. Once the markets wake up to reality, silver is likely to have a far greater percentage gain than gold. If gold goes to $42,000 an ounce, silver at a 16 to 1 ratio would be at $2,625 per ounce. Even if it settles at a 40 to 1 ratio, we're still looking at silver over $1,000 per ounce, not the 30 where it's sitting today. That's an incredible opportunity for those paying attention. And let me tell you, the banks and institutional players already know this. They are accumulating precious metals behind the scenes while telling the public to stay in fiat. This is the big question. How much do you need to protect yourself? If you want to preserve your wealth, you need gold. If you want barterable assets for day-to-day transactions, you need silver. Here's a simple rule of thumb. Calculate your annual expenses. Let's say it's $50,000 per year. Decide how many years of protection you want. If you want a 10-year safety net, that's $500,000 you need to protect. Use gold and silver to secure it. Given their revalued prices, you might need 12 ounces of gold and 250 ounces of silver. This is an individual calculation, but the takeaway is this: get started now. Let's be clear, this is not financial advice, and I'm not telling you what to do. But history shows us that financial systems break. When they do, those who hold real assets come out ahead, while those trapped in fiat suffer devastating losses. It's no longer a question of if the system will collapse, it's when. And if you're still sitting in dollars, stocks, or other paper assets, you're taking a huge risk. Gold and silver are undervalued, manipulated, and suppressed, but only for now. When the next financial crisis hits, the people who are holding real money will be the ones who not only survive, but thrive. So let me ask you, are you going to be one of them? There's an old saying, when the tide goes out, you find out who's been swimming naked. Right now, the financial system is a house of cards, and when it collapses, those left standing will be the ones who prepared in advance. Gold and silver are not just investments, they are financial insurance.
So we do a much more detailed list than this, but that's basically what you're looking at. That directs you to the percentage in silver and the percentage in gold, which is another huge question that I get all the time. And it depends on the individual and what you are trying to accomplish with it. And we have a whole comprehensive list of what you need barterable silver for and what you need barterable gold for. Now, and I'm also, by the way, not saying that you can't do all of these things with, a silver quarter. It's just that it's the right tool for the job. That's how we approach it. So now we're going to look at how much barterable silver, how much barterable gold, and for how long do I want that coverage. We do it annually at first, and then personally, I have enough coverage for myself and my daughters for 10 years. This is a global issue. It's going to take a minute to walk through. And so that's what you have to determine for yourself, and we'll help you do that, is how many years do you want that coverage? And guess what that tells you? That tells you how much gold and how much silver in barterable form you need to sustain your standard of living for however long it is that you are wanting to do. On the barterable part, we're going to look at silver first because this is such an interesting long-term chart. You always have to look long-term because you can see anything short-term, but long-term, what we've got are two huge cups, right? Silver currently has not concluded this cup. This is what I keep talking about, that, well, maybe it's not going to happen by the end of this year, but it's working on it and it's definitely happening. So it'll probably happen next year. But since this is a double cup, here's this one big cup, here's this next big cup. Once that breaks above that, can you see how silver is likely to go toward that $2,000? Because it works like a spring. I think I have a spring in here. I do. Works like a spring. And if you hold that spring down and you suppress it and you suppress it and you suppress it, when you remove your hand, it springs. In this case, if it breaks that top, it'll spring up. It's just what always happens. So this is a huge technical pattern, especially with two major cup formations. Are they showing you this? No, they're showing you short term. They don't want you to understand how to get into position to protect yourself. But this is why silver will absolutely go to its fundamental value once it crosses that line. And it's why you see in some currencies, or at first, that we could see that gold and silver ratio grow a bit more narrow. However, once we enter the hyperinflationary stage in earnest, we won't see that anymore. So the volume also, you can see how that is escalating. This is the volume of trading, right? It's become a huge trading instrument, and that's done with contracts. That's not really done with the physical metal itself. Though this guides the bullion prices, and you can hold all of this inside of a traditional IRA if that's what you choose to do. That is not the choice that I personally made. I have a huge retirement plan, but it's outside of it, and is definitely includes, junk silver, pre-64 constitutional silver, as well as rounds, as well as new stuff, because I'm not really concerned about confiscation of silver, simply because it gets used up in industry. But we have to talk about gold as well. So we want to accumulate your wealth. We want to protect what you have managed to accumulate so far. So we're going to take a look at that. We're also going to take a look at how you are currently generating your income, or how you plan on generating your income. And we're going to account for all of that, including any fees, any taxes, any losses, anything that we have to account for. And it's not really rocket science, because if gold is worth $42,000 an ounce at this moment in time, and it's trading at $2,700, you simply recoup that when it goes to fundamental value. This is not rocket science. This is just logic and simple thought process. So how much gold do I need to protect what I've already accumulated? Like I said earlier, in the 403Bs, I'm sorry, you're not going to be able to take a withdrawal. And if you're currently contributing to a 401k, you're going to have limitations on how much you can take out as well. So we want to make sure that whatever you have to, or choose to, right? This is your choice. Whatever you choose to keep inside of the system is properly diversified and therefore protected.
Gold prices have historically risen when people become concerned about the erosion of purchasing power in fiat currency-denominated savings instruments. Globally, the world's reserve currency remains the US dollar, and by default, the premier savings instrument is the U.S. 10-year Treasury. Understanding this dynamic is critical to appreciating why gold has been surging and why it is likely to continue doing so. If we look at the arithmetic surrounding the U.S. Treasury market, the first point to recognize is that the current deterioration of the purchasing power of the U.S. dollar is conventionally measured using the Consumer Price Index, CPI. However, the CPI is an inefficient and somewhat misleading measure of the real decline in the dollar's value. The official CPI numbers suggest that inflation is running at around 2.6% per year, but many people would argue that this figure vastly underestimates the actual loss of purchasing power. Just take a look at your daily expenses. Health insurance premiums have skyrocketed, grocery bills have significantly increased, mortgage rates have doubled, and rents are through the roof. If you analyze your expenses from 2000 to 2025, the reality becomes clear. Inflation is far more severe than what is officially reported. For example, my personal analysis, despite being relatively frugal, suggests that my true rate of purchasing power erosion is closer to 7.5% per year rather than the reported 2.6%. I encourage everyone to conduct a similar exercise and determine whether their cost of living has truly only increased at 2.6% per year, as the government claims. This discrepancy between real inflation and the official numbers has serious implications for Treasury investors. If you accept the CPI number at face value, the arithmetic around the U.S. 10-year Treasury doesn't seem too bad. Investors are getting paid around 4.5% in a currency that is supposedly losing only 2.6% of its value annually. That would imply a small but positive real yield. However, if we use a more realistic inflation number, closer to 7.5%, the situation looks dramatically different. In this case, investors are receiving a 4.5% return on their Treasury investment, while their purchasing power is eroding by 7.5% annually. That means they are losing 3% in real terms every single year. Over a decade, this compounds into significant wealth destruction. The idea that the U.S. 10-year Treasury is a risk-free asset is absurd if it guarantees a loss of purchasing power over time. Who would want to lock up their money in an instrument that ensures a long-term loss? This is precisely the kind of environment where gold thrives. Gold has already responded to these conditions, but it remains significantly underowned by mainstream investors. The primary buyers of gold over the past 3.5 years have not been everyday Americans, but rather foreign central banks and sovereign wealth funds. These institutions are not just worried about inflation, they are actively seeking to de-dollarize their reserves. Their concerns stem from two major issues. First, they are opposed to the U.S. government's weaponization of the dollar, using it as a geopolitical tool to enforce economic sanctions and influence foreign policies. This has led countries like China and Russia to diversify away from the U.S. dollar, preferring assets that cannot be easily confiscated or frozen, such as gold. Second, they recognize the same inflationary problem I described earlier. If you're a foreign nation sitting on trillions of dollars in U.S. Treasury holdings, and you see that your returns are not keeping up with real inflation, why continue holding them? Why not trade in some of those treasuries for gold, which has historically held its value during periods of inflation and economic uncertainty? China, for example, has aggressively increased its gold reserves while simultaneously reducing its exposure to U.S. debt. Instead of earning a paltry 4.5% on U.S. treasuries while suffering from higher real inflation, they are choosing to store their wealth in an asset that has no counterparty risk and a history of retaining its purchasing power. This trend is not limited to China. Other countries, including Russia, India, and the BRICS nations, have also been accumulating gold at unprecedented levels. The challenge to U.S. dollar hegemony is growing, and gold is playing a central role in this shift. One of the most compelling arguments for gold's continued rise is its relative under-ownership in the broader financial system. According to J.P. Morgan Chase, the total market share of precious metals and related securities is currently less than 0.5% of total U.S. savings and investment assets. That's an incredibly low number. Historically, the average market share for gold and precious metals-related assets has been around 2%. This means that if gold merely returns to its historical mean, Demand for gold and related investments would quadruple. When you consider that gold supply is relatively inelastic, it cannot be printed like fiat currency. This expected surge in demand could send prices soaring. Gold doesn't have to replace the US dollar or completely displace the treasury market. It simply needs to regain its historical role in investment portfolios. Even a modest reallocation of global assets toward gold would result in a substantial increase in its price. This is why I own gold. Not because I think it might inch up to $3,000 per ounce, but because I see a realistic path toward gold reaching $9,000 or even $10,000 per ounce in the long run. Such a scenario isn't just speculation, it is grounded in historical precedent. The last time the US dollar experienced a sustained loss of purchasing power was during the 1970s. From 1970 to 1980, the US dollar lost more than 75% of its value due to inflation. At the beginning of that decade, gold was price controlled at $35 per ounce. By the end of the decade, gold had skyrocketed to $850 per ounce. That's a 24-fold increase in just 10 years. When you look at today's economic landscape, the parallels are striking. The US government is drowning in debt, with on-balance sheet liabilities exceeding $36 trillion and off-balance sheet liabilities, mostly related to Medicare, Medicaid, and Social Security, surpassing $100 trillion. In total, the net government debt burden exceeds $130 trillion, a level that is simply unsustainable. History has shown that governments do not default outright on their debt. They default through inflation. The most politically viable way to reduce the real burden of debt is by inflating its value away. This means continued money printing, continued negative real interest rates, and continued erosion of the dollar's purchasing power, all of which are bullish for gold. The key takeaway here is that gold is not just another commodity. It is a form of financial insurance. It is a hedge against inflation, a hedge against currency debasement, and a hedge against systemic financial instability. The reality is that we are living through an era of unprecedented monetary and fiscal policy experimentation. Central banks are printing money at record levels, governments are running massive deficits, and investors are being forced into riskier and riskier assets just to keep up with inflation. In this environment, gold's role as a store of value becomes more important than ever. So while many investors remain complacent, believing that inflation will somehow return to 2% and that central banks have everything under control, history tells us otherwise. The lessons of the 1970s and other inflationary periods make it clear that once inflation takes hold, it is incredibly difficult to contain. If the dollar continues to lose purchasing power, gold is likely to be one of the biggest beneficiaries. Given the growing interest from foreign central banks, the underallocation of gold in investment portfolios, and the historical precedent of how gold reacts to inflationary crises, I believe we are in the early stages of a much larger gold bull market. Investors who recognize this early and position themselves accordingly will be better prepared for what lies ahead.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.